Hi guys, this is Dan from the Investment ABC, your guide to financial freedom. And in this video, I want to discuss if the recent correction is just a correction or the beginning of a longer term decline or even worse, a bear market. So let's start. Since the lows in March of 2020, the stock market just knew one direction, and that was upwards. This was due to the unprecedented amount of actions the central banks and also governments of the world took to save the day. The Fed balance sheet skyrocketed like GameStop shares from 4 trillion US dollar in February 2020 to currently around 7.5 trillion US dollar all-time high. An increase of the Fed's balance sheet means nothing more than the Fed is creating new dollars to go into the bond market and to buy up bonds to keep interest rates low and keep liquidity high. Governments also help people and businesses out left and right by sending direct stimulus checks and giving away PPP loans. This just not happened in the US but all around the globe, so it was no surprise that risk assets began to move upwards again despite the real economy cratering. Smart investors and also institutional money started to enter the market again since the 10-year Treasury yield was also at record lows at around 0.6%. Furthermore, many retail investors had to stay at home because the economy was closed and many had to find a way to make ends meet online. During that period at home, many retail investors found apps like Robinhood and the easy money in the stock market. Many wish that they would have found this golden goose earlier. You put $1,000 into the stock market and in a couple of days you get 1,500 back. Rinse and repeat. This was the birth of the retail investor as a force in the stock market after almost 20 years. The last time retail participation was that high was during the dot-com bubble. I remember that period quite well since I have started investing during that time. Many retail investors were trading while doing their day-to-day jobs, and I've seen cashiers, for example, sitting next to the computers trading while doing their daily job. The problem with retail investors during the dot-com bubble and also right now is that they are not financially educated. So they are bidding up prices since they are getting greedier and greedier, and most of them don't know how high is enough now. They don't know the valuation of the company. A good example of this behavior was the CCIV stock, which was bid higher and higher just on speculation alone that the company might potentially merge with Lucid Motors. The valuation became so high that financially educated investors said enough is enough and started to sell. I have been warning in my last videos that CCIV was overvalued, but the problem is when people are greedy, it is hard to listen. It is not only CCIV right now, but the whole stock market and especially the tech stocks. The valuations are just not justified. You want to invest in a company so that at some point the company is making a profit and you can profit as an investor also from that. But if you're investing now and the company is making a profit in 20 years when you're already gone, there is no logical point in investing. You are plainly buying the stock to find another fool that is paying a higher price for the stock. This kind of environment might last 1 month, 1 year, or even 2 years, but at some point, the last fool who's willing to enter the stock market and pay crazy prices is already all in. At that point, no one is willing to pay these prices, and by the time the market peaked, financial educated investors already have exited the market and are waiting on the sidelines for prices to come back to the underlying fundamentals of the companies. Most of the time, those people buying at the top will need to hold for a very long time to break even, or worse, they have invested in penny stocks without any fundamentals, which in that case, they will lose everything. So have we run out of new retail investors who are willing to throw their money into the market? I'm not 100% sure about that, since normally market psychology changes with some kind of catalyst. For example, the sickness last year, Bear Stearns or Lehman in 2008, and the World Trade Centers in 2001. Me personally, I don't remember seeing a bull market ending without a catalyst, but the further prices are away from the fundamental, the smaller the catalyst needs to be to bring down the house of cards, so we have to be extremely careful here. If we look at the charts of the S&P 500, for example, we can see that the S&P is in this rising wedge and is testing the lower boundary currently. If we break to the downside, we could quickly go down to test 3,500 points. If we have a look at the Nasdaq, we can see that the Nasdaq Composite is also close to testing its upwards channel. If we break here to the downside, the next target would be 12,000 points. We have lost already more than 8% from the top on the Nasdaq, which would be a normal correction. Even if the Nasdaq is going back to 12,000 points, we would have a 15% drop, which would be still a correction. In my opinion, having a 15% correction would be very healthy before continuing further to the upside. Many people are also confident in the government and central banks to stimulate further. They are anticipating a new round of stimulus and further low interest rates. In my opinion, a correction and further upwards movement would be the preferred scenario before at some point inflation picks up and forces the Fed to either raise interest rates a la Paul Volcker or let the inflation run havoc. According to Jerome Powell, there is nothing to worry about. He thinks the increase in the money supply will not lead to inflation. He has been right in the past, since the money was stuck at the banks as reserves or mainly in the financial assets. But the difference this time is that the governments are handing out stimulus checks to the middle class, who uses this money to buy consumer goods or groceries instead of investing it into financial assets. Investors are realizing this and also front-running the increase in inflation by buying commodities, which increase inflation pressure even further. Even the rise in financial assets alone would have led at some point to higher inflation, because rents would climb higher and higher like they have done pre-crisis, since house prices continue to climb. Another risk for the stock market might be increased taxes on big corporations to pay for all the stimulus, which would hurt corporate profits. The Fed created a monster that they have let loose right now and which can't be controlled anymore. Everyone is running into risk assets because either they are looking for higher yields or trying to protect their wealth. The outcome will be a currency crisis on an epic scale, which will force central banks to raise interest rates and pop the everything bubble and bankrupting the majority of the people on this planet. Most investors know that the stock market is totally overvalued when looking at most of the conventional metrics like PE multiples, the Buffett indicator, Shiller PE, and so on. But they don't have an option, since the only counterpart to stocks, bonds, aren't the risk-free alternative as they used to be. On the contrary, bonds are a ticking time bomb. Therefore, no one wants to hold them for a long period of time. Maybe for a trade to dump it onto the central banks who are willing to buy everything. But the money is flowing into all sorts of assets until the wealth gap between rich and poor will be so high that the poor won't take it anymore. We are forced to play the game, so let's dance carefully and pray we can jump out of the stock market before it finally really crashes. So I'm going to slowly buy into the market right now, but only into stocks with great fundamentals and future, but will make sure that I have always enough cash at hand. This is just my own opinion and no financial advice, since I'm no financial advisor, guys. Always do your own due diligence. If you like this video, hit the like button to support the channel, share, comment, and subscribe for early stock picks. You can also join our Patreon for instant buy and sell alerts when I find a stock with multi-bagger potential. Here is a list of stocks that I have bought already in the past, and you can check out my videos to those stocks if you are interested. Bye guys, and see you in the next one.